Hello and welcome to the Index Investor, a series from Value Research that helps you decode passive investing. In this episode, we're talking about why index funds are the smart choice for long-term investors, especially if you want simplicity, discipline, and performance that holds up over decades. Joining me today are Kartik Jhaveri, he's director at Transcend Capital, and my colleague Ashish Menon, he's senior equity analyst here at Value Research. Welcome, gentlemen.
Hi, thank you. Thank you for having me.
Good to have you here. Ashish, I'll come to you first. Long term is a term that we hear often, we use often, but when it comes to investors, what does it really mean in time and in terms of mindset as well?
So when we say long term, we're not talking about any fixed number of years. But for all practical purposes, look, anything less than 5 years is too short to ride out the market's mood swings. See, most importantly, long term, it is a state of mind. It is your ability to invest without being swayed by all these short term noises. You have elections, you have some budget announcement, oil prices, there's some headline about recession, inflation, etc. So it's about being able to block all these out and remain invested. So, like a real long term investor is someone who understands that the returns from equity they come in a very lumpy fashion. See, there'll be years where you have sharp gains and then a lot of years of decline as well. But over a decade or so, those lumps they even out and you end up with a significant amount of wealth. So let's take a case of the last 10 years. Markets have given you roughly 14% returns. But when you look at the first 5 years, that is 2015 to 19, it is just 9% returns, which is something little more than fixed income, right? And then you take 2020 to 24 and you have 19% returns. So this is the kind of lumpiness that an investor should be prepared for. See, if you find yourself worrying every time market falls by 10%, then you're not thinking of long term. You're thinking ki, what will happen when my next statement arrives. See, to truly experience long term investing, you don't experience it until that returns portion of your portfolio when compared to like the amount of money that you've invested till date, that becomes the larger portion of it. So it takes you about 10 to 12 years, assuming your portfolio earns at 12%, for that returns portion to start dominating. So that is the bare minimum required of an investor to truly understand what long term really means.
Right. Kartik, coming to you from a financial planning perspective, why do you think time in the market matters so much more than timing the market?
It's kind of pretty much connected to your first question. How long should a person be invested? So, from our point of view, when we are talking to clients, when we are talking to investors, we generally tell them that look, you take out the money. Either A, you have a need which is very well defined and which we have already planned for in advance. You take the money out that time, or you let it just compound for an enormously long period of time, because the fund manager will do his activity, the world and the economics and the political framework, they will do their activity. But ultimately, as far as you're concerned, you will compound, you will make a lot of money. So the thing is now, coming to timing. Now, let's talk of the most recent times, okay? Very, very recently, what has happened before us is two major events. I mean, in fact, both of them are kind of ongoing in some sense. When you look at it from that point of view, we had a period in April. Nobody knew that the market was going to go down by about 6,000 points, 8,000 points, and then just bounce back up the next day. Now, if you had tried to wait, things are looking bad, things are looking, not so nice and things like that. Let me put in money, let me not put in the money. You probably miss those best days. And there is a lot of analysis that has happened by a lot of people, institutions, saying that if you were even to miss out the best 10 days in the last 10 years, the difference in your returns could be as big as 2 or 3%. And on a compounding basis, it turns out to be quite a substantial chunk. So the point here really is that it doesn't matter, what is happening. I mean, to give you exact dates, it was 7th of April as I'm looking at. Just in the 7th of April period, and when we look at Sensex, when we just talk about Sensex, like in 2 days, the Sensex fell down by almost 7,000 points. It's crazy. How would you ever have imagined that something like that could happen? And then in no time, from that very day to the next 4 days, it just went up by as much as 7,400 points, literally in 3 days. So you can't really time this. It's impossible to try. I mean, even if you do the best of technical analysis and you're subscribing to a lot of technical inputs, astrological inputs, geopolitical inputs, everything put together, ultimately, if you just stay put, then finally you'll end up. And my own portfolio, which I share with a lot of investors who are first-time investors who come in, and I show them, funds that I have done for myself, my kids, 15 years, 17 years, and the money has multiplied 12 times and 15 times in a mutual fund. Not even a stock, but that kind of compounding of 17%, 18%, 19% is something that we live by because we see it happening in our own portfolios. And that's why, when we tell somebody that, hang around in the market, don't be fragile, don't be timid, don't get out when you see a 10%, 15% fall. You're not a hedge fund. You're here and you're going to be invested for so many number of years. So stay put, have patience, and understand that this process will create money for you. And this process will create the wealth that we are aspiring to. Goals will get fulfilled, but follow the patience, follow the discipline. It'll all work out.
Right. So now that we've figured out what long-term really is, let's move on to how index funds support long-term goals. So one of the biggest advantages of index funds is low cost. So can you explain with real numbers how this cost advantage compounds into significant gains over, say, 20 or 30 years?
So let's take a simple example. 1 crore, if you had invested for a 20-year period, and well, okay, for all the ones who are not so familiar with index, let's actually just tell them for a bit. Every mutual fund charges you a certain amount of fee. That's how the mutual fund runs. Let us say that average fee is, for example, 1.5%. Just ballpark. There are funds who are charging 1%. There are some at 175. Very few at 2%. But let's say 1.5 is the fee. Now, if you are in an index fund, then the cost is 1%. So you're saving about 0.5%. Okay, the reason the fund manager or the mutual fund is giving you this as a facility is because they just have to replicate the index. So they are saving a lot of time, money, energy, and effort in terms of creating a portfolio, actively managing it. Whatever the index has, they just have to map it. Or whatever the index has, they may have made it ETF, they just have to buy the same thing. So, for them, the effort goes down to maybe, by 90%. It is very, very scalable and a lot of people can participate into that. So just that same example, if we were to earn a rate of, let's say, 14%, just as an example, we would make about 13.75 crores. 1 crore invested for 20 years would bring home about 13.75 crores. If you just paid that 0.5% more, the difference would be as much as 75 lakhs. So 15 crores versus 13.75. So just that 0.5% saving could actually change your returns by as much as 1 crore 25 lakhs over a 20-year period. So small change over a long time can make a difference. But there's a caveat here. We should not just get swayed away by this. There is a lot of merit in active. And we are very, very new in this passive space. Meaning we as a country, we as a market are quite new in this. And we were just doing an analysis a while ago just to try and do a comparison of what an active fund has done versus what an index has done. So in a lot of cases, we found that we are still slightly actively driven market. The active funds have still overperformed or outperformed on the index. So while globally, this is a great phenomenon. America has probably, more than 3,000 or 4,000 of such ETFs and index funds to invest in. We are slowly getting there. And literally at this moment, every week, every few days, there is a new fund which is being launched, which is some sort of a combination of an index or a strategy over an index. So that's the way forward. A little cost can make a massive difference. That's a second fact. But you can't take that blindly. You need to do a lot of analysis, understand, and then invest. If you're going to go to invest in a plain vanilla index like a Nifty, Next Nifty, Sensex, mid cap, small cap, you're still okay. But remember, there can be outperformance over that. And you're going to feel very bad in a year like 23, 24, where the index went up by about, say, 40, 45% and funds, went up by 60%. So you're going to feel like that you've lost out big. So these kind of things do happen.
A lot of investors who are especially the do it yourself kinds, the simplicity of index funds, that's a huge plus.
Yes.
How does this consistency help investors avoid common behavioral mistakes?
So let's talk about the mistakes first and
Yeah.
then come back to this so that, one gets a better perspective. So what are some of the fundamental mistakes that happen? And they happen every few years. Is the same thing that happens because there's always a new set of people who are coming in, and we find ourselves telling them pretty much exactly the same thing to them after every few years. Just the person is different, the answer is the same. Okay. So what is happening right now? Indian markets have done literally zero performance over the last 12 months as we speak. So we have to tell them that, look, sometimes markets do this thing. The reasons could be a lot of things. Could be geopolitical. Could be that, internationally, whatever is happening around us. The other fact of the matter is maybe our corporate results, the company's profitability is a little bit suffering. But that is also somewhere got to be connected. So reasons always are there on the table. Okay. And reasons change from time to time. But the fact is that every few years, what happens is the market rallies and then it cools off for some time. It shakes off the excesses. Everybody starts talking that, everything's overvalued. When those things happen, there is a little bit of a shake off that happens. Things get normalized. A lot of things get reset. And then fresh money again starts coming into those investments. And then the next rally begins. So that's typically, how it happens. But it doesn't really go like a sine wave, which just goes up and comes back to the same point. That luckily doesn't happen for us because as an economy, we are improving from time to time. So even if you did not want to follow an advisor, did not want to do complex calculations, did not want to take complex advice and all of that, wanted to do a very simple DIY thing, remember one thing, that in the last, for example, 20, 40 years, let's say, where the Sensex, for example, was at a level of 100, from there it is at 82,000. So if you look at the compounding number, that number is about 15 to 16%. So even if you do nothing and you just invested into that Sensex or a Nifty, you would still come home with between 12 to 15% compounded returns without you having to worry about anything little figure. But then you don't act like a fund manager, or you don't act like a maverick and then say, oh, well, the markets are down, everything's looking good, looking bad, let me pull out. Don't pull out. Don't reallocate. Just stay there. So that's what the market has done. It has not gone up and not gone below the last level. It goes up, comes down a little bit, then goes up and then comes down and get a little bit. But it doesn't go down below zero. That has not happened in the last 40 years. You see? So that is something they must understand, that we are a growing country. Economy is moving forward. As long as there is growth happening, the investments will also remain profitable. So do not lose heart, do not lose patience, and do not lose faith.
Right. So patience is the key there. Ashish, let's talk about performance and track record of index funds. Kartik just mentioned that active funds have still performed better and we're relatively new in this passive space. But over long periods, how have index funds stacked up against active funds in India, and any patterns that you've noticed in different market cycles?
So historically, active funds in India, they have had a comfortable lead over index funds because the markets were little less research, and the good fund managers, they could find plenty of mispriced stocks. But the narrative has kind of changed in the last, say, 7 to 10 years. See,
Okay.
the markets have started to become more and more efficient. SEBI's categorization norms, they have brought in some constraint to active fund managers. So the gap has narrowed sharply in the recent years. In fact, if you take a look at the large cap space, most of the fund managers now find it a big challenge to beat the index consistently. So if you randomly pick a large cap fund, majority of them are not going to beat the index over longer time. So this is a space where, as an investor, your odds are better off if you pick an index fund. But when you come to mid caps, now you can slowly start to see that it has become a 50-50 kind of a narrative, and it is slowly gravitating towards how large cap funds are. But small caps is still a space where, the fund managers have a significant scope for outperformance. So when you look at the pattern, it becomes clear over a full market cycle that, in big bull runs, these active fund managers, they look great because they've taken some big bets and they have paid off. The same thing, when a correction happens, you'll often find that the index is stacking up better because their bigger bets have fallen more. But when you take a fund which is pretty much diversified like the index, then in the large cap space, at least, it is broadly similar to how the index is performing. Over a full cycle, an average active large cap fund right now looks kind of like the index, minus the cost difference, of course. So all in all, your large cap funds, they are in a space where, active management is struggling, and you will find a lot of fund managers admitting that, yes, it is definitely a challenge when it comes to the large cap space.
Kartik, what should a long-term index investor do during a major market crash? Should he be tweaking allocations or just stay invested?
See, now there are two facets here. Either the investor is working with somebody, or or the investor is a DIY investor doing everything himself or herself, right? So if you're working with somebody who's watching the market all the time, what happens is you are even more dispassionate. So to understand this better, we have to talk about stocks for a minute.
Mm-hmm.
So what happens is when you have a portfolio of stocks, your favorite bank, your favorite FMCG company, your favorite telecom company, and your favorite oil company, all of that. So when you have these companies, people fall in love with them. They can never sell it. So the argument given was, why don't you invest in a mutual fund? Let the professional decide which of your favorite company he should invest at what point in time, and he will not be as emotional as you are. So he will let go of some companies, and he will bring those companies later on when the opportunity arises in those companies. So he will buy and sell those companies. So you buy units of a mutual fund and you just sit back and enjoy the ride. So that is the presentation or that is the submission that the mutual fund gave. Now we have ETF, which is a very efficient, low cost option vis-a-vis the same mutual fund. Also, what happens is over a period of time, fund managers will struggle, like Ashish was saying. So that is also true. In extremely developed markets, the reason for the number of ETFs in an American market being 4,000 plus is exactly this. But that's not the only reason. The other reason is also the regulator is trying to tell you, reduce your cost, reduce your cost. So when you have to reduce your cost, you have to have something which is technology enabled, smarter and scalable. Okay, cannot replace the human judgment, but at the same time, it's as good as it, because as good as it gets. So that's why you have these things. Now, what will you do in a drawdown? So going in a roundabout fashion, you can be completely dispassionate. If your advisor has a understanding of the market, if your planner is telling you that perhaps this is a time where you can reduce your allocation to equity from say 95% that you are at the moment to maybe 65%, you will in an instant be able to decide that. The decision making is so much faster. You don't have to think about it because it's not a stock. It's also not your favorite mutual fund, because people also fall in love with their funds. Because if a fund is, like I mentioned, fund goes on for 15 years, you fall in love with that because I invested 2 lakhs today. The value of that fund is 25 lakhs. I don't want to sell that, So I will think 2,000 times before my advisor tells me, okay, book it, because he's being dispassionate about it, but I'm extremely passionate about it. So when you are in an index, of course, this same story will happen in an index also, because that is human nature. But at least you don't know what is actually going out, what stocks are going out, what stocks are coming. You are to that extent so much more, for the sake of brevity, you are so much more astute, or you are so much smarter with your money, because you're not worried about iske piche kya hai. You're just going ahead and selling it off. So that way you can protect your capital. At the same time, in a drawdown, when you've accumulated some debt funds or you have some debt allocation, you can go and attack. So in a drawdown, probably your index funds will be the fastest decision making enabler for you. So that's the reason. I think that's one more angle to why people should start considering some of these index funds. And today, we are spoiled for choice. We have hundreds already. And even financial advisors are somewhere grappling to understand the length and breadth of all these funds, because they're coming at that speed. See?
So if someone is a DIY investor in times of market crashes, should they be tweaking their allocations?
No, just stay put, because you have chosen to do it yourself. So don't try and do extra stunts. Basically, like they say, that these stunts are performed by professionals. Don't try it at home. So basically, if you're a DIY investor, okay, nothing's going to go wrong. and which is what I show to a lot of my investors also in our own portfolios, that look, everything happened, right? Kargil war happened, and IT crash happened, and off late COVID happened. And despite that, today, if your 1 lakh rupees is sitting at 10 lakh rupees, do you really need to worry? It will go down to 9, it will go down to 8, but then the next rally, the next wave that happens, it will again go back to 14 and 16. So just stay back, just don't try and do anything. See, what happens with the DIY, the problem is, with the problem of plenty, you're given too many choices, then you don't know what to choose. Then everybody's feeding you information. Again, a second problem. Then the third thing is you don't know how to react at different market times. So sometimes best action is inaction. Just don't do anything. If you're a DIY investor, remember one mantra: every time the market falls, and if you're a DIY investor, go put a little extra money there. Because you can't be wrong. When the market is down, you're buying something a little extra, because this is the best asset class, somewhere where your money is going to get the best treatment. So every time it comes down, go ahead and put a little bit of. That's as simple as that.
Right. Ashish, since we're talking about staying invested through the ups and downs, some viewers might wonder about tracking error, which simply said is how much of funds returns differ from its benchmark. So can you please explain what tracking error really means for long-term investors, and when should they actually worry about it?
So like you said, tracking error, it's just the difference between what an index is delivering versus what your fund is delivering. So this comes from a couple of reasons. One is the cost of running the fund, which is reflected in your expense ratio. Then the fund is allowed to hold up to 5% in cash for redemption. So that will also reduce the returns, or depending on markets. Then there is the timing and accuracy of rebalancing. So index constituents, they change. So whenever they change, the fund has to do that. So depending on that, there may be some difference in the returns. See, for a long-term investor, a small tracking error of say 0.2 to 0.5% annually, that is just the cost of doing business. You shouldn't worry too much about it. But look, considering the fact that the difference between what an active fund and a passive fund charges, the tracking error is not something to be worried about too much. Now the question is, when should you worry? See, if the tracking error is consistently high, say above 1%, and there's no explainable reason for it, then you should definitely worry, because either the fund is not rebalancing well or it is charging too much. So these are the things. But look, in India, most of the large, well-run index funds, they keep their tracking error very low or within a reasonable range. So as far as the disciplined investor is concerned, this is not at all a deal breaker.
Okay, so how can investors use SIPs and index funds to steadily build wealth even through volatile markets?
So again, here comes the role of, it's a good idea to work with somebody, not to advocate the cause of all the brokers and distributors, but there is a little bit of sense. Now, SIP is a fantastic tool, right? But now, if you look at the last 1 year, even SIP returns are negative. For example, there are intermediate periods where for even 3 years, SIP returns have been negative, for example. So what happens is SIP, and we talk about STP, which is the slightly bigger brother of SIP, just together, a systematic transfer plan where somebody puts it on lump sum, and then every week or every month, we are doing the same process as that of an SIP. Okay. Now, what happens is, how much SIP to do? Now, every person has a certain amount of budget. Say somebody's budget is 30,000 SIPs. Okay. Now, a clever thing would be to either put the 30,000 completely when the market is in a kind of a momentum, we are in an upward trajectory. But when the market is volatile, like you said, should you actually be putting the entire 30,000, or should you be putting 10, 20,000 and maybe a 10,000 in a liquid kind of a fund? Accumulate that money, use that as a ammunition. And when the market goes down, if you have somebody who's watching your portfolio for you, then that person can tell you that, okay, here's the time to go allocation of 90%. And we were at the moment at 60% or 65% equity, but this is the time to go 90 because the markets have corrected so much. Everything's, all the bad news is out of the market. We are watching it. All our analysts and fund managers and research houses from wherever we've analyzed are telling you, Mr. Customer, that this is the time to go 90. Then what happens is that customer's experience will be so much better. Even on the downside, it will be better. Even on the upside, it will be better. But if a DIY guy is going and just putting, he knows SIP is a good idea or STP is good, he goes bang, 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 and he puts the money inside. What happens is sometimes that experience can turn out to be pretty sour. Then comes the STP angle. Whether you should expose your money. Now, we are just graduating because it's a continuation. So we are graduating to STP. If you had a lakh of rupees instead of 30,000 every month, but if you had a lakh of rupees or 10 lakhs, lump sum investment, should you expose that money in a 6-month period via STP to the market? Should you take 12 months or should you take 18 months to do that? Again, this is where somebody who's watching the markets can give you a reasonable, nobody's like, has the gospel truth with them, but at least that person can be better off because you are doing your job and this person is looking at the market. So maybe that person might be able to tell you that here is a time, for example, go and break your money into 12 parts, or which is the next 12 months invest, or the next 6 months go and invest because correction is almost coming to an end. So that little bit value addition could go a long way in the kind of experience that you will have. So yes, SIP is a great answer, but then asset allocation is equally important, actually more important. So you need to decide at different points in time how much money or your SIP budget or your STP budget, how much should go into equity, how much should not go into equity, and at what time should you move your allocation from 60 or 70% to 90% or from 40% to 80% as the case might be. So that's the only thing to remember. But otherwise, yeah, broadly speaking, SIP is a good idea if you insist on being DIY. Don't worry. And volatile times, the mantra is the same, add more. Increase your SIP or make some ad hoc investments. At least that way, your average price or your average cost is coming down considerably. So when the next wave or the next rally happens, your appreciation is that much better.
Right. So let's also talk about different life stages. When does it make sense to rebalance an index fund heavy portfolio, and how should this be done at various life stages of a person?
So I actually don't believe that it should happen on life stage.
Okay.
Prima facie. It should, if you think about it realistically, right, it should happen based on financial circumstances.
Mhm.
If a person is 80 years old, has enough money to take care of themselves, has got, let's say, maybe 2 crores in a debt fund, pure debt fund, or a fixed deposit, earning 6%, and if that person's need is getting fulfilled of living a comfortable life without any compromises, and if that same 80-year-old person had another 5 crores extra money, would it be sensible to do adjustment based on life stage? Because that person may want to give it as a legacy to their children and grandchildren in future generations. So it's all about circumstances, which is number one. Secondary fact is, yes, life stages. And in an index fund, again, rebalancing becomes easier. See, the beauty of an index fund is you don't need to have too many funds, firstly. That's a massive advantage. Okay. If I were to make a mutual fund portfolio for somebody, I would say take 2 large cap funds, take 2 mid cap funds, take 2 small cap funds. And each of these funds will be with a different AMC so that we are diversifying our team risk also. We don't want to give all our money or significant percentage of our money to one team. Let's also diversify across not asset classes, but teams of management also. Now, versus this, over a period of time, the person will have 6 funds, then those many debt funds, because sometimes you do asset, and then sometimes they will want sectoral funds, and over a 15-20 year period, the number of funds become about 15 or 20. You see, and sometimes in many cases I've seen they are much more. It's like a whole portfolio or a bouquet of funds, but that's a different story. With an index fund, you just need one large cap, right? Whether X is doing that, or Y or Z or A or B or P or Q or R, everybody will have the same fund because they are mapping the same index. Little bit of difference, 19-20, like we said, in terms of a tracking error. But broadly speaking, it will do it. The objective is to do the same thing. The same for a mid cap, the same for a small cap. So just imagine, or just one flexi cap, just one fund. Imagine the ease and the speed and the efficiency at which you can do allocations. So if a person's financial needs are getting fulfilled, person is going to a senior age, let's say is crossing over to the 60s and wants to bring down the allocation, in a single switch, you can just go out 30% of the money. So analysis is simpler, clutter is lesser, chaos is absolutely not there. Life is that much more easier for yourself, for the chartered accountant who's filing your returns, and for everybody else who's doing all the administration on your work. So if you are in an index fund, choices are very, very limited because you have only those many indices. But I mean, those guys have also become very smart. Now there's a whole truckload of different indices. That's a different story again. But otherwise, it's very easy, very simple. So it's extremely easy to rebalance.
All right, on that note, time for us to wrap up this chat. Thank you both of you for joining in and for the clarity.
All right. Bye-bye.
Thank you. And to our viewers, remember, wealth isn't built overnight, but with the right strategy and the right tools, you can make the journey much smoother. If this episode helped you simplify things, hit subscribe, share it with a friend, and stay tuned for our next episode of The Index Investor.